Welcome to Explain the Charts, where today we are conducting an in-depth analysis of the QQQ, representing the Nasdaq-100, on this Monday, March 16, 2026. The market is currently navigating a complex web of geopolitical tensions and technological breakthroughs that are creating significant swings in price action. As we open the week, the primary focus is on the conflict in the Middle East, which has now reached its third week, keeping investor sentiment on edge. Over the weekend, reports surfaced that several tankers successfully transited the Strait of Hormuz, sparking hope for a reopening of this vital energy conduit. This news has led to a pre-market surge in Nasdaq futures, with gains between 0.8% and 1.1% as we enter the trading session. However, the threat of a prolonged war remains, with some economists warning that we may be underpricing a growth slowdown heading into the second quarter. Compounding this uncertainty is the Federal Reserve's two-day meeting starting tomorrow, where officials are expected to hold interest rates steady despite energy-driven inflation. On a more bullish note, the technology sector is buzzing with NVIDIA's annual GTC event and a massive $12 billion AI infrastructure deal signed between Nebius and Meta. We are seeing a market that is deeply divided between macroeconomic fears and strong underlying fundamentals in the artificial intelligence space. Goldman Sachs has cautioned about a near-term correction risk, while other analysts suggest this could be a generational buying opportunity if the conflict de-escalates. In this video, we will look at how this news is directly translating to the candles on our screen to help you decide your next move. Looking at the daily chart, we can see that QQQ has been under considerable pressure since the beginning of March 2026. On March 6th, we saw a significant drop as the Dow plunged over 500 points, pulling the Nasdaq down along with it. The price action on March 9th provided a temporary relief rally, which was triggered by comments suggesting the war could be over soon. Notice the long lower wick on the March 9th candle, indicating that buyers stepped in aggressively near the 594 level to defend that support. Since that reversal, however, the price has struggled to regain its previous highs from late 2025, which sat comfortably above 630. The high volume on down days during the last week of February and the first week of March suggests that institutional selling was prevalent. Last Friday, March 13th, the QQQ closed near the bottom of its daily range at 593.72, down a full 1% on the day. This weakness was largely driven by Brent crude prices climbing back above $100 as the Hormuz crisis deepened. We are currently sitting in a volatile range where the 590 to 600 zone is acting as a pivot for the entire index. The daily candles show a series of lower highs, which is a traditionally bearish signal that we must respect until a clear breakout occurs. Switching over to the 1-hour chart, we can gain a clearer perspective on the Trump bounce that occurred earlier this month. During the session on March 2nd, the index hit a local low of 591.87 before the dramatic turnaround began. The hourly candles show a steady climb throughout the week of March 2nd, peaking near 610 as sentiment improved momentarily. You can see how the 608 to 610 range has now flipped from support into a very stubborn resistance level. Every attempt to sustain a rally above 610 in the last few trading days has been met with selling pressure. The volatility is best characterized by the wide ranges between the hourly opens and closes, reflecting a market that is unsure of its next direction. The recent hourly data from March 13th shows a steady decline from the 603 open to the 593 close, suggesting a lack of buyers at the end of the week. Today's anticipated gap up will need to hold above the 600 level on the hourly chart to signal any real bullish momentum. Watch for a potential gap and crap scenario where the price opens high but quickly sells off as traders lock in profits from the news. The volume on the hourly chart has been consistently high, which confirms that these price levels are being heavily contested by both sides. Now let's zoom in even further with the 15-minute chart to analyze the micro-movements from last Friday's session. Early in the morning on March 13th, the QQQ attempted to rally, reaching a peak of 603.41 shortly after the open. However, this rally was short-lived, as the price began a multi-hour descent that broke through several minor support levels. By mid-afternoon, we saw a consolidation period around the 594 level, which acted as a temporary floor before a final dip. The last 15-minute candle of the week closed at 593.44, showing that the bears were firmly in control going into the weekend. This microanalysis confirms that the 597 level, which acted as support earlier in the day, has now become a point of resistance for today's session. If the market opens above 600 today, these 15-minute levels will be critical for determining if the move is a sustainable trend or just news-driven noise. We are looking for a series of higher lows on the 15-minute chart today to confirm that the pre-market optimism is translating into real buying. The relationship between the declining price and the steady volume suggests that the sell-off was orderly, not a panic-driven crash. This orderliness gives us hope that a recovery is possible if the geopolitical situation continues to stabilize in the coming days. To summarize the current state of the QQQ, we are at a major crossroads that depends heavily on the headlines. Our key resistance levels to watch are 610, which has rejected the price multiple times, and the macro level of 625. On the downside, support at 590 is the most critical floor, and a break below that could lead us toward the 580 level quite rapidly. I would place the likelihood of a sideways, volatile market over the next week at 60% as we await the outcome of the Federal Reserve meeting. A bullish breakout above 612 becomes 70% more likely if the Strait of Hormuz is officially declared safe for all commercial traffic. Conversely, a bearish breakdown below 590 is highly probable if oil prices sustain a close above $105 per barrel. Keep a very close eye on the NVIDIA GTC event, as any negative surprises in the AI outlook could override the positive geopolitical news. Long-term, the trend still shows resilience, but short-term traders should be cautious of the cloud of uncertainty mentioned by analysts. Wait for a confirmation candle on the daily chart, either a close above resistance or a bounce off support, before committing to a large position. Thank you for watching Explain the Charts, and remember to stay disciplined in these high volatility environments. This video is for educational purposes only and does not constitute financial advice. Always do your own research before making investment decisions.